how close would you say is what's going on today with the current market that we have to 2007, 2008? What's different about it? What similar trends do we see? And what blind spots do we have that we're saying, it's not a big deal. We're not in recession. It's not as bad as people make it out to be. We're going to be okay. How similar is it? How different is it from '08?
Well, so over the last, really following the financial crisis, the Federal Reserve and Congress and the government had to stimulate the economy to get things stabilized, which they did, and then things progressed. However, what happened is the Fed got hooked on easy money monetary policy. They kept interest rates way below the rate of inflation. They flooded the money supply into the system so that everyone had plenty of cash, had lots of liquidity.
Is that quantitative easing? Is that
No,
what that is?
well, quantitative easing on top of it. And then they decided to go out and purchase originally about $4 or $5 trillion of treasuries and mortgages. And what that did is it bid up the prices of those. That drove down long-term interest rates and forced everybody into the stock market and real estate market. So it caused those asset prices to go up dramatically. So I think we are in the biggest bubble, or risk of a bubble, that I've seen in my career. Bigger than what it was in 2007.
You believe that?
Absolutely. If you look at what's happened in housing, and we may have hit the speculative peak now, I don't know. But we try to go back and look and see what's a long-term trend line of what real estate should be doing nationally. And in 2006, it became very concerned. We were above trend line. It looked like it was inflated by about 10 to 20% higher than it should be. And it appears to be more inflated today than what it was leading into that period. So that causes me concern. The difference today is that the stock market similarly increased in value much greater, faster than the rate of inflation or the rate of earnings growth or the growth in the economy. So stock prices are much more inflated today than they were just prior to the financial crisis. This time, we've also seen collectibles and other more exotic instruments escalate at prices that appear to be way above their intrinsic value.
When you say collect, like NFTs, collectible cars, paintings.
Crypto, a whole variety of things. Now, it appears that bubble peaked a year ago, and so we've had some major corrections in a lot of them. You see Bitcoin down 2/3 in value, and a lot of other things I think are starting to self-correct itself.
Didn't you just say that the entire crypto market assets are now under $1 trillion? 2 years ago, just Bitcoin alone was atop of $1 trillion.
Yeah.
Just to put that in perspective, the entire crypto market is now under $1 trillion. 2 years ago, just Bitcoin alone was $1 trillion.
Wild.
Yeah, so the things that concern me, one is I think the Federal Reserve has been way too aggressive in easy money policy. They kept interest rates too low, too long. They flooded the system with too much money, and the quantitative easing of buying assets forced asset prices up all over the world. And then the follow-through on that is every central bank in the world saw what they were doing and did the same thing. So now we have the potential risk of a global asset bubble. So this thing's not just a U.S. issue. It's all over the country, including countries like China, where it's a whole different topic, but it may be the greatest real estate bubble in the history of the world is sitting there.
That's what this evergreen situation.
That's one reflection of it. And so that concerns me a lot about what the Fed's done and how it set us up for a major problem. And then we have the federal government going off and incurring the last decade about $1.7 trillion a year of budget deficits. Now, some things are necessary. So coming out of the financial crisis, yes, of 2008, we needed to stabilize for a short period, but they got hooked on it, and we've been budget deficits ever since. Then we hit COVID. And yes, I understand short-term measures, but I think we put too much stimulus for too long, and that's increased our debt to about $30 trillion for the country. Well, when the Fed keeps interest rates too low, that also encourages everybody to go out and borrow. So again, we were talking about all the borrowing that people went out to do on homes and stretched on homes and all that stuff. Now it's across the board. It's got consumers, businesses, and governments. Our government in particular, but every government across the world. So we have the greatest level of debt in the world's history. We're at $300 trillion of outstanding debt now, which is the greatest percent of GDP in the history of the world. So we have a system, highly levered, built on the back of assets, which I think many key asset categories are inflated and maybe at bubble status. So that creates an enormous leverage, risky system. And if something comes into it to disrupt it, and we saw what COVID can do short term, but what will wars do? What will cybersecurity things do? What would political unrest or constitutional crisis in the United States, or some of the civil unrest things that we have? And we've also set up a country now where our inequality is the greatest it's been since right before the crash of the stock market in the 20s. We are approaching that kind of inequality status. And so when you think about a country, it's not just about, are we all going to do okay in the short run? You got to worry, are you setting yourself up where the very democracy that we're built on is at risk because there's such a large percent of the population that is being left behind and the like. So I think there's a lot of risk out there. Very difficult to project if and when that's going to happen, but I found over decades of looking at it from an investment side that whenever everything gets way above trend lines, that's probably a good time to be pretty cautious. And on the other side is you will have periods where everything is really attractively priced relative to those trend lines, and that's when you really want to be aggressive on the buy side. So if I'm just doing it right now, I say this is a good time to be cautious, keep your powder dry, and
still keep it dry.
I would keep it dry, particularly in real estate, because look, the numbers don't work. You can't have housing going to these record levels where affordability is now the poorest since the 80s, and interest rates probably have to continue to go up because if you think inflation is going to be higher than about 2.5% or so, maybe 3% at the highest, on a long-term basis, interest rates don't reflect that yet. Interest rates have to go up more if that's where we end up stabilizing.
So if you like this clip and you want to watch another one, click right here. And if you want to watch the entire podcast, click right here.